After Hours. This is our January 14th edition of Bond Squad After Hours. Before we get started, let's make compliance happy. Investment advisory is offered through Private Advisor Group. Private Advisor Group is a separate entity from WS&M LLC and Bond Squad. Well, the question being asked among investors and market participants is what's wrong with the markets. We've seen tremendous volatility the past few weeks, especially the past week. We've seen the long bond, the 30-year Treasury, dip as low as 242. That's the lowest I've seen, and that's the lowest in the history of the 30-year Treasury. We've seen moves in the equity market of 100, 200, even 300 points. Yesterday, we saw a swing of about 400 points from the top to the bottom of the day. We've seen equity prices follow oil prices, but we've seen stocks that should benefit from oil prices, such as airlines, rally as oil prices rallied at the end of the day today. Now, we don't think at Bond Squad that there's much inherently wrong with the markets or the economy. If there's anything wrong, it might be with market participants and investors. By that, what we mean is we believe some pretty irrational assumptions were built into asset prices and to market conditions. For instance, China might only grow at 5 to 7% this year, depending whose figures you believe, including the official government figures. All right, growth of 8, 9, 10, 11% were factored into many investment strategies from a few years ago. We have the copper, which was not only used in construction in China, but also used as collateral on loans because it was figured it would always be in demand. They're going to keep building these cities. People move from the country and whatnot, but probably overdid it a bit, So now you see copper dropping off. You're seeing oil drop off. And the consensus among investors, even some of our old colleagues, has been, well, oil can't stay here. It's not profitable for many companies, for some countries. Look, Russia loses money below 100. Iran loses money below 100. Venezuela loses money below 100. So those countries are really taking it on the chin right now. And so the thought is, well, oil can't stay that low. The Saudis won't tolerate this much longer. It's got to go back up to 100, as if 100 or 80 or 90 or 110 or whatever is the normal price. Jim Cramer said something tonight on his Mad Money show. Now, Jim Cramer is in this case is right. Sometimes he's psychotic, but he's right. The man is smart. You love him or hate him, and I happen to like him. He's a very smart guy, and he said something very much along the lines of what we've been writing for the last 6 months. What we might be seeing now, and he says we are seeing now, but I'll say what we might be seeing now is the real price of oil. Now, it could be 50, it could be 30, it could be 60, but he pointed out that the higher prices of oil might have been the OPEC price, when OPEC commanded everything. All right. We don't have an OPEC monopoly at this point. We have North American production. We have South American production. We have production in areas with strong private sectors, property rights, and profit motivation, not state-run oil companies. That's the difference. OPEC was a cabal, a cartel of state-run oil companies. They all got together, said, all right, we're going to move prices up in unison. And they did. And that became a pretty good strategy for traders and investors. If supply got too great and prices dropped, OPEC comes in, cuts supply, prices go up, yada, yada, yada. Problem is, even when OPEC had command, prices, both real and adjusted for inflation, never got as high as they had during the height of the housing bubble and recently. For instance, the highest crude oil price prior to the housing bubble was just under $40. I want to say 39. No, I really should. Well, let me take a quick look here. Hold on. I can see it, you can't. That's another compliance situation. The highest price of oil prior to the housing bubble was in the third quarter of 1990. Remember, Saddam Hussein started the Gulf War and hit 39.60. I knew it was over 39 and it was under 40. We never broke $40 on oil until the second quarter of 2004. That's the first time ever we broke $40, and it went from there. By 2006, oil was at 75. But at its peak at the end of the second quarter of 2008, it was up up at 140. Okay, that was not normal. That was the peak oil story. What we had going on was a booming U.S. economy, a rising China, and not enough production to keep up with it. Remember, we heard tar sands in Canada, is barely profitable at 100. So 140, all right, maybe you get tar sands up. But shale, wow, I remember hearing about shale, 15 years ago, and I said, wow, if only we can get the shale oil out of the ground. We only find an efficient way of extracting oil from shale. Yeah, probably not going to happen in our lifetime. Peak oil is here. Well, on about 2011, what happened? We got oil out of shale more efficiently. And it wasn't realized how efficient it had become. For instance, when oil started to nosedive about mid-year 2014, there were some fears out there that if oil got below $80 a barrel, what would happen is we would see OPEC jump in, and or some of these oil companies would become unprofitable. There'd be turmoil in the shale oil sector. Well, we went to 80. Nothing much happened. We went to 70. Not a whole lot happened. 60, 50. Now we've been bouncing around the mid to high 40s. Now, it's true that some of these shale drillers, the least efficient ones, will probably either have to merge, restructure debt, or simply file for bankruptcy. But what was not counted on was that the Saudis would sit on the sidelines. And you know why? Because the Saudis know, as well as I do, as well as Jim Cramer does, as well as the markets do, that oil at 100 was a contrived price based on a dynamic that did not come true. We were looking at supply and demand, and it's funny, in the Fed's Beige Book section, report rather, the Dallas Fed, I believe it was the Dallas Fed, it was in the Beige Book, stated that actually it was the Kansas City Fed, I apologize, noted that the supply of oil, the growth of the supply of oil was outstripping the growth in demand in their region. And that's happening throughout the country and throughout the world. We have a approximate 2 million barrel daily surplus. God, we talk about oil so much and copper. We should make this commodity squad after hours, I guess. But it plays into the bond market, so bear with me here. We have a production surplus. So the quick answer is, well, why doesn't OPEC just shut production or scale it down? Well, they could. The Saudis could go tell OPEC, cut production 2 million a day, and you might get a temporary spike in oil prices. It probably brings you to some sort of equilibrium. Maybe that's $75, $80 a barrel. But what happens at that point? Well, it encourages more production, doesn't it? The wells that are going offline and the exploration projects that had been put on the shelf, all of a sudden, they fire them back up again. And what happens? Oil starts to go down again. The problem here is, with those who think oil's going to snap back, is that they're living in the past. The past was the OPEC oil market. For the first time since approximately World War II, we have an oil market that is being heavily influenced by production in free market economies where the private sector rules. Okay? So no one's going to come in and tell the United States, or nobody in the United States is going to go tell the shale drillers, all right, you're not producing any oil this month. You're going to scale it back. Cut your production by 1 million barrels a day. It's not good. They'll do what's good for them. And since Many of them, if not all of them, have leases and debt to pay. They need to generate revenue. Even if it's not 100% of the revenue they need, it's still revenue. Because if they shut production, what happens? They still owe this money. Right? Still have to pay for the lease. To the auto industry, prior to the auto industry restructuring a few years ago, we had Chrysler and GM were actually losing money in the auto business. But because they had the jobs bank, and Ford had it too for that matter, but Ford wasn't quite losing money thanks to Alan Mulally. But they had the jobs bank. So they would have to pay their workers 95% of their wages and benefits if they idled them, if they told them to sit home. So what they did is kept building cars. They would lose on any at one point. I remember it was any car below $22,000. It sold for $22,000. They would lose money on. All right, but they built it anyway. They kept building them. Whether they're profitable or not, they needed to pay these union contracts. They needed to pay, upkeep on the plants. They needed to pay taxes, whatever, unless they wanted to just go out of business, right? And that's not what their goal was. They didn't want to default and go out of business. So, GM and to an extent Ford decided to make money in the auto financing business, but that's another story for another edition of Bond Squad After Hours. But my point is, when you have fixed obligations that are entrenched, they're ingrained, you can't get out of them short of a default. You need to generate revenue. So you'll keep pumping this oil. You might not explore for new oil, but you're going to keep pumping it for what you have now as long as you can. So the question becomes, where is the real price of oil? Well, the real price of oil might not be that much different than it is now. I don't know where it is, but no, you know what? Neither is anyone else. We're in uncharted territory here. And this is spooking people because in the past, or at least in the recent past, which is people seem to live in if they think back at all, the only time you saw a sharp drop in oil was from demand destruction. You saw it following the tech bubble. Remember back in 2000, I remember filling my tank up 99 cents a gallon for regular, and you saw it after the housing bubble. Again, oil prices plummeted. This time, it's not so much demand destruction. In fact, there is no demand destruction. Demand is growing. It's just growing at a slower pace than people predicted or had hoped. And I think hope is a more accurate word. And production has increased at a faster pace than most people assumed. So you have a different supply-demand dynamic. And this slower consumption growth comes from, you have right off the bat, you have Japan and Europe, which are pretty much ships that are dead in the water. You have China, which is slowing down, and it needs to slow down. There are bubbles all over the place in China. Whether they're allowed to burst or whether they're buried in the depths of government, who knows? But China is a house of cards, and the Politburo and the premier go around, propping up the ace of spades here and there, So, China demand was overestimated. Plus, you have more efficiencies here. Our cars get much better fuel mileage. Our heating systems burn less fuel. And in the Northeast where I am, there's still a lot of homes that are heated in the wintertime by heating oil, home heating oil. So, but they use a lot less oil than they used to in the most modern systems. So we have a dynamic that wasn't priced in, and where I feel bad here is there are a lot of investors out there who I think were sold a bill of goods. They were sold the idea that QE in Europe is coming, and when it does, it'll recover. I had an accountant tell me that I was nuts buying anything past 7 years because when Draghi comes in, we're going to see rates skyrocket. I mean skyrocket. I was told they were going to soar because they'll fix their problems, as if cheap interest rates are the problem in Europe. But that's yet another problem, another discussion, because Europe is structurally broken. It's Japan 15, 20 years ago, So we don't have that demand coming online. I mean, we don't have demand growth in Japan. We have slower demand growth here in the U.S. than anticipated, and greater production. Oil can't help but to go down. But yet people, when they see that, they say, oh, it's telling us something. It's telling us the economy is no good. Really? Well, the U.S. economy is actually pretty good. Now, retail sales for December weren't that great. I think too much hope was built into what oil prices might do for consumption, in the core economy. Now, it's only one report too, but it is a bit disturbing how weak it was. We had the control group core retail sales down 0.4. That's not good. That's not good. Even if oil prices were still at 100, that's not good. But we're not imploding. Right now, is Europe imploding? It could. Is Japan imploding? It's shrinking. Its population is shrinking. It really has no choice. But it's not. Low oil prices are not telling us that we're heading towards a recession. Low oil prices are telling us that we have tremendous supply growth. All right, versus somewhat less demand growth. Now, some of the supply growth you could say it was fueled by the Fed. The Fed lowered prices, lowered interest rates, right? So money had to go somewhere to generate yield. So it started to go into junk bonds and loans. And with anything else, it starts with the better, relatively speaking, in the junk market, the better opportunities, the ones with a better chance of paying out based on underlying fundamentals. And that pushes those yields down, tightens spreads. So more money comes looking for yield, it goes to the next best one, and then the next best one, and then the next best one. By the time you get 3 years in, the best ones out there, are probably Confederate money for all we know. It could be basically worthless. We saw the bond of one oil services company, and I'm not going to mention the name because compliance doesn't like that on a broadcast like this, trading at 5 cents on the dollar. Now call me tomorrow, or email me. I'll tell you which one it is. I can do it on a one-on-one basis, but 5 cents on the dollar. Okay. Meanwhile, some of them are out there still 88, 90, 95 cents on the dollar in the junk world. So the market's starting to differentiate the winners and losers out there. And we at Bond Squad think that's a good thing. You can't have all assets going up at the same time. There has to be some differentiation. Problem is, people were told that's not going to happen. No, never going to happen. The Fed will inflate everything. We'll have higher interest rates. The economy will boom again because that's just the way it is. And consumers will spend. Well, consumers are still highly leveraged on a historical basis. They have low leverage versus the housing bubble, but a lot of leverage they paired was from just defaulting on it too. So the credit ratings aren't the greatest. So we still have consumers out there who are like, well, I still got some debt. I might have defaulted on a home, so my credit's not great. I might have kept paying my home, but I'm upside down in it, and my mortgage payment's really stretching me. Consider that I lost a good paying job after the financial crisis, and I'm probably working 2 part-time jobs now. So what happens is that when you get this drop in fuel prices, and there were some signs of this in the data, these consumers, rather than spend, they're paying down debt. They're using it to get some breathing space. Maybe the younger consumers are using it to say, wow, I can pay my student loans. I don't have to run afoul of Obamacare, and I can pay the penalty. If I don't have if I don't sign up for health care, I can stay out of trouble. And so there's some of that. Now, stay down for a long time, and they might start spending some, but it's not this big rush to spend as people think. This is not our old economy. The economy is always changing. We've said this, we've beaten that to death. But so low oil prices are good. They will give some relief to the consumer. They should increase household spending. It should boost the broader economy, or at least keep it going. But it's not this panacea everyone makes it out to be. So let's switch over to the bond market now, right? We talked about enough commodities and consumers, and this, like I said, this is Bond Squad after hours, not Commodity Squad after hours. So now let's link this to the bond market. We see long-term rates at or near all-time lows. Well, we see the long bond floor bouncing off all-time lows. We saw the 10-year get down to 180. It was down in the high 150s at one point in its life. Not today, years ago. So that's not at its all-time lows, but we're seeing long-term rates start to fall. And again, people living in the past, the people, who believe World War I was the war to end all wars, and the Maginot Line would prevent World War II, which it didn't, are out there saying, well, if you're at 180, 183, 184 on the 10-year, where's approximately where we are right now. That signals that the U.S. economy is in trouble because, look, why should rates be that low? But remember, interest rates are not an absolute. Interest rates are all relative. All right, like we said last week, our 10-year note yield is about 4 times that of the German 10-year. All right, on a relative basis, we're cheap. We're attractive. And our currency keeps going up versus the euro. So you have a currency arbitrage going on. All right. Then you have another thing to consider. We are probably in a structural, secular, disinflationary environment. This is not cyclical. Okay. Oil prices aren't cyclical at this point. Disinflation is not cyclical. This is very much structural. And we started to even hear that on CNBC today, which is we're thanking the Almighty that we're starting to hear that on that network, because with the exception of some very bright people on there were a few, but the mantra has kind of, well, I wouldn't say the mantra has been against that. They really have not really addressed it. But we're seeing, we got the acknowledgement now that things are structural out there. So when you look at a 183, 184, 185 10-year note yield, and you consider, well, inflation is running at 1.4, 1.5 in the U.S., and it's flat or negative in Europe and Japan, and they could drag our inflation down, to 1, and then falling oil prices can drag headline inflation down maybe below 1. All of a sudden, the 10-year Treasury is priced right, isn't it? It's priced right for that environment. If you think that environment is coming, that low 1% area inflation rate, then you're right. There was a lot made of tips, saying the tips break evens, are so low. They're pricing in inflation well below 2, especially the 5-year tip is like a 138 last I looked, and the 30-year tip is around 180. It's pricing at a 180 inflation rate. I say, wow, they're underpricing it. Yeah, maybe they're overpricing it, at least for the time being. Now, we're not going to say for 30 years it'll never go above that level. That's stupid to say that, But it's also stupid to say that can't go below 1. And I think it goes lower before it goes higher. Yeah, this is structural, guys. Okay? This is not a cyclical, a temporary. This is based on fundamentals. Change the fundamentals, and you'll change that environment. So when we see those long-term yields, we're not at a 180 because the U.S. economy is weak. We're at a 180 because the U.S. economy is strong relative to Japan and Europe. Okay? And everybody's waiting on Mr. Draghi on the 22nd to come and do QE. Like we said last week, QE's done. The market did it for him. German 10-year is 47 basis points. French 10-year is below 1. 3/4 of a point thereabouts. The euro keeps plummeting, 117. It could be at parity by Easter. Who knows, right? It's getting there. The only thing QE over there will do will be to justify what's already happened. But we've been 6 months with this, and there's been no turnaround. We've been 6 months of declining euro and plunging long-term interest rates in Europe, and nothing has happened. Now, I know it takes time, but you hope to see nascent signs of this changing. It's not, and it's not changing, and that's because the problem in Europe isn't that credit is too expensive. Credit is not desired in the same way that it's desired here. Population doesn't grow like it grows here, and when it does grow, it grows a lot from immigration from the Middle East, not organically internally. Okay, it doesn't have the same type of animal spirits. People immigrate aren't necessarily entrepreneurs. Go to any major city, look at the small fruit stands and the small businesses. A lot of them are run by immigrants, right? They come here and they add to the economy. They don't come here and sign up for benefits. They're all, and despite some narrow-mindedness in this country, they're not discriminated against as they are in Europe. Right? So, so it's a different economy. It's a very closed economy compared to us. So you can't draw comparisons. The best comparison out there for Europe is Japan. And we've seen what near zero interest rates and quantitative easing has gotten Japan for the last 20 years. It's gotten them nothing. Or maybe it has. Maybe it would have been worse if they didn't do that. That's counterfactual. You can't prove it, but maybe that's what the result would have been. Who knows? So these low rates, they're indicative of our strength, believe it or not our weakness. But people don't get it. I mean, the financial journalists don't get it. They really don't. I mean, we saw another article today in the Journal saying that the bond market is pushing long-term yields down, long-term rates down, in spite of the possibility of the Fed raising the Fed funds rate. Does anybody understand how the yield curve works? How the long end of the curve prices in inflation expectations, the short end is run by the Fed, and higher short-term rates are anti-inflationary. So when the Fed raises short-term rates, at some point, the yield curve flattens, long-term rates stop. Long-term rates don't go up because the Fed is tightening. The Fed tightens because long-term rates are going up. And the reason long-term rates are going up is inflation. So it's indirect. The Fed tightens because inflation is strong. Long-term rates go up because inflation is strong. The yield curve starts to flatten because the Fed is fighting inflation, usually. Okay? So what happens is the long rates go up first because of inflation pressures. The Fed usually lags, comes in and starts to tighten. But inflation pressure is still there, so the long end of the curve goes up. Then the Fed gets more aggressive, becomes anti-inflationary, long-term rates stop rising. The Fed keeps going to make sure inflation is killed. The curve flattens or inverts, right? That's where you get your recessions or slowdowns, right? The economy slows down too much, the Fed starts to ease, right? It lowers rates, it creates some more inflation, and the curve steepens again. So what we should expect when the Fed is going to tighten is a curve flattening scenario. Okay. Now, at what levels interest rates, or the yield curve rather, flattens depends on inflation. You have inflation running sub 2, probably sub 1.5 this year. That means the long rates are not going to go very high. They might not budge from this point. We still think by the end of the year they creep up a little bit. Might not. But if the Fed tightens anyway, even though inflation's not a problem, because they need some more ammunition to fight the next crisis if and when it happens, and they might, and it might only take it up 25, 50 basis points in the end of the year. They might not take it up at all this year. They might wait for 16. If we were the Fed, actually, we were the Fed, we'd tighten because we'd love to, inflict a little discipline on the momentum guys who think that the Fed is their friend and the Fed is a put. Start doing your homework and base your decisions on fundamentals, right? Rather than momentum. Momentum is an amateur's game, in our opinion. But we're bond guys; we always look at fundamentals. So, but what could happen is that we have a yield curve that starts to flatten. Well, it's already started to flatten, but starts to become fairly flat with all rates below 3. Could happen with rates below 2.5. At the end of the Fed cycle, it's possible to have 2.5 Fed funds to 30 years, or Fed funds at least to 10 years. Could happen. Don't think that long-term rates have to go up. It's not a given. And low rates are affecting decisions by corporations. We've seen bonds called in that we didn't think would be called at this point. We're starting to see step-up notes that don't step up for a few years, but are callable now. But coupons in the 3 area, 3.5, start to get called in because it's cheaper for them to call it in and refinance that debt for the next few years at less than 3. They can finance for 10 years at 3. Never mind some of the stuff that doesn't steps in within 4 or 5 years. Why chance it? Call it in and refinance it now. Rates might not be higher in a few years from now, but are they going to be that much lower? If they are, great. I'll just refi again. But that's what's happening out there in the bond market. We saw so much hope put in to Fed policy, to put into oil production, and everybody ran for yield. Everybody ran to energy. It's another bubble, a smaller bubble than housing, but it's a bubble. It's probably not going to be systemically damaging, but it's a bubble. And if you invested your money or your client's money beyond their risk tolerance to pick up that yield, and chose to believe the pie in the sky stories the salespeople were telling you as they traipsed through your office, then shame on you. I know it's difficult. I know people need a certain amount of income to live on. But what's going to happen if some of these bonds start to default? And most people don't own the actual bonds, and they definitely don't own the actual loans. Individuals usually can't. You're going to start to see share prices of various vehicles start to get hit, and people are going to start selling out at losses. Meanwhile, in the bond market, we every now and then we see some weakness in bonds that are probably going down more in sympathy, or because portfolio managers are being forced to sell. You can pick up value there. We've been looking at it. We've run numbers on various companies, balance sheet leverage. I'm a strategist. I'm not a credit analyst. I do have a decent knowledge of balance sheets. I know what balance sheet leverage is, and I know when it's problematic. I know all about interest coverage. So that's not my primary job, but I've been tearing through things, and there are some opportunities out there. But suitability is a tremendous factor here. They're not for everyone. Single B paper should never be considered safe. It's always aggressive. It's always speculative. It could be a good investment, but it's always risky. And I think investors are getting a lesson in that. They're getting a lesson in stocks. They're not all stocks are created equal. And they don't know what to do with volatility. They used to have everything going up, but the Fed is still our friend. Rates are still low. Rates aren't low. Our rates are high, relatively speaking. Everything is relative. It's not absolute, right? So one strategy we suggest, and just a base case strategy, you have to make your own decisions. But if you have too much risk, and this is a volatile market on the up days, so pair some of your risk. On the down days, buy the quality. We've seen quality stocks and bonds get hit on the sell-off. Why? Dividends are going to matter, guys. Income is going to matter. Your bond performance, a lot of it is going to be from coupon. Here's a hint. A triple C bond's coupon should not be relied upon, ever, in any circumstance. If it was reliable, it wouldn't be rated triple C, would it? So that's a total return investment. Most people invest in that stuff to buy it at 50 cents on the dollar, hope to get 60 in a bankruptcy, or sell it, when recovery value has been better analyzed at a higher price, hopefully. So that's all we had this week. We ran a few minutes late. I could go on all night. I doubt you can. But, the old saying of the old off-track betting in New York, bet with your head, not over it. Too many people bet over their heads, and now they're panicking too much. Move up in quality. Buy your blue chips. Buy your investment grades. If you're an aggressive speculative investor, snoop around for some double B stuff. Energy, we still love the oil and gas pipelines, especially gas. Gas not easily exported or imported. So we're profitable below $3 a million BTUs. There's probably no interruption of the flow of natural gas through the pipes. Probably a good investment on the bond side. You have to take some volatility because there will be knuckleheads panicking out there who are ill-advised or unadvised. But there are opportunities there. So consumer cyclicals, consumer staples, and consumer cyclicals. Look at the more middle class related ones rather than luxury. That's where if falling fuel prices will help anyone, it's going to be that area of the consumer cyclical. Watch out for autos. If we don't see a boost in income, and I don't think we see wage growth. I mean, we wrote this today. I don't want to beat it to death because we wrote it in the report. But for those who are watching who don't read our reports, who are just tuning in for the first time, lower oil prices keep headline inflation low. Headline inflation keeps cost of living increases for most union workers, Social Security recipients, and pension recipients low. All right. It also reduces the need to ask for or seek out higher wages, because it itself is almost like a wage increase. All right. We are probably in a secular low to moderate wage growth environment. Today's Fed Basebrook data kind of bears that out. This isn't bad. It's just different. All right, the relationship between hiring and wage growth, between demand increase for oil and prices. It's all changed. And you know what? 10 years from now, it'll be different. Don't know what it'll be, but it'll be different. 10 years ago, it was different. 50 years ago, it was different. Right? But here's what it is now. All right, start looking under the hood of your investments. Start reassessing your portfolio, and start getting. If you're outside of your normal parameters, get back inside. And with that, I wish everybody a good evening. Please, with any questions, comments, criticisms, give us a call during market hours at 570-424-1555. And if you need to email us, it's thomas.byrne, B-Y-R-N-E, at W as in whiskey, S as in Sierra, the word A-N-D, M as in Mike.com. And please have a good night. Stay warm. It's cold up here in the Poconos. But tomorrow will be another interesting day in the markets. Have a good night. Goodbye.